Welcome back to Global Money Talk. The world is on edge right now with escalating conflicts in the Middle East, and markets are reacting in ways no one expected. To make sense of this chaos, we're joined today by a heavyweight in the industry, Max Gokhman, Deputy Chief Investment Officer at Franklin Templeton Investment Solutions. Today, we're asking the tough questions. Why is crypto showing such incredible resilience despite the war? Is this the bottom we've all been waiting for? Max breaks down how the market has deleveraged and could be poised for a rebound, as well as the best way investors could get exposure to crypto assets. From the AI-driven recession fears to the midterm election cycles and the ultimate debate, Max discusses how AI can create millions of new jobs and the surprising sectors that could really benefit. Finally, this is a deep dive into the mind of one of the sharpest strategists in the game. You're going to want to take notes on this one. Let's dive into our conversation with Max Gokhman. Max, welcome to the show.
Thanks so much for having me.
Well, we're really excited to have you here. You've carved in kind of an unusual path in the industry, starting from quantitative macro hedge funds and AI-driven asset management to now running Franklin Templeton's investment solutions. Our readers and our watchers, I should say, are interested in the Mosaic investment platform, which is an unusual and revolutionary system. Can you just give us a quick overview of Franklin Templeton Investment Solutions and Mosaic?
Absolutely, I'd love to. So I'll start with what Franklin Templeton Investment Solutions, and I'll refer to it as FTIS afterwards, so it's not quite as much of a mouthful. We love our acronyms at Franklin. And that will naturally explain why we actually built Mosaic and what Mosaic is. So within FTIS, we run over $100 billion across almost every type of mandate. We have traditional fund of funds in things like retirement strategies, like target date funds. We run very sophisticated mandates for institutions that cover very specific and nuanced objective, which could include total return or inflation protection or specific sustainability objectives. And then we run mandates for sovereign wealth funds and for pensions, for foundations, for even central banks that span the gamut. We also have alternative strategies, both done in-house and through a hedge fund of fund platform. And we have ETFs that we run for investors. We run model portfolios for different wealth management platforms. And we also have our own bottom-up systematic equity strategies that we run, again, for a broad range of investors. So a little bit of everything, right? So with all that, and also with a team that's spread out all around the globe, how do we actually invest in a coherent way? That was the question that brought us to the creation of Mosaic. Mosaic is really an investment operating system. And the question I usually get after that is, okay, what is an investment operating system? Think about your phone, whether it's Android or Apple, it's got an operating system on it, right? So what it allows you to do, for example, is to run Gmail and Outlook and the built-in mail app. You can run Photoshop or Snapseed or another photo editing application. And you can drag and drop all your data, whether it's that picture you edited in Photoshop into your Gmail or something else in between, and it just kind of works, right? And you don't have to change your workflow to suit the operating system. That's kind of the mark of good software. Something like that does not exist, or did not exist, I should say, in investment management until we built Mosaic. You typically either had to work with very disparate systems like an optimizer for building an efficient portfolio, a totally separate risk model for looking at that portfolio and projecting risk on an ex-ante basis, and then plugging all of that into an order management platform so you could run everything, or you had to use an integrated tool that really constrained the way you invest. So actually, the tools would make you change your investment approach by the nature of how they required you to manage your workflow. And as investors, we tend to think that one of our biggest edge is actually being able to have a unique process. So how do we contain that? And that was the idea and the genesis behind Mosaic, is that we can have a very modular app-based ecosystem that prioritizes data integrity. And when I say data, I'm talking thousands of different time series from both internally generated signals from things like GDP and company fundamentals and data on flows and other technicals, to pricing and holdings for hundreds of different benchmarks, all updated in real time, all checked in real time for accuracy. And then that data can flow into different applications. And we can have a different flow for our hedge fund to fund system and strategy than for our systematic bottom-up equity strategy because they're fundamentally different processes. And even across similar strategies like our retirement strategies, we can have portfolio managers choose to interact with their portfolios in the way that makes sense to them. So that's really the goal of Mosaic. We've been building it since I joined for about 3 years. We're just getting to the point where it's really standing up and we're starting to really use it for investment workflows. And we've also actually started releasing it to clients, specifically our institutional clients. So for any institutional client watching it, if you would like to talk about Mosaic, we've got some really unique applications that we think are industry leading. And I'll say one last thing about Mosaic because this may lead to some other questions, and then I'll stop. We've also developed some really unique AI functionality within Mosaic. And the idea with that is really that we didn't want just shiny, cool AI stuff. Like there's a lot of companies that have recently just added AI and they've dropped the large language model on top of their existing tool, and it can like summarize what you're working on, or it can make simple suggestions. We've actually built proprietary AI models, and now we've built proprietary AI agents that can do things like help an investor evaluate a manager, help an investor solve an infeasible optimization problem. Those are the kind of things we're doing. So they're solving real investment issues in a way that's much faster and more streamlined than what you could do before. So that's a little bit about solutions and a little bit about Mosaic.
And some of the interviews you've done, I found something particularly fascinating, is you said that you shouldn't put more than 20% of your asset in more than one volatility class. I'm not sure if I've said that quite right. That means you should have your volatility and manage your volatility very carefully. And part of one of my frustrations, and it'll remain nameless, is I can't even find the beta of the equities that I hold in my current, sort of box, much less figure out what my overall volatility or exposure to equities or fixed income is. So it seems like if you'd be able to do this, and that would be quite an advancement actually, to be able for the investor to see how much risk they actually have on.
Absolutely. So first of all, yes, I did say that. I think a general prudent rule, and again, there's exceptions to that rule for certain mandates, but as a general rule, you shouldn't have more than a fifth of your risk in any single asset class, whether it's equities or fixed income, digital assets, et cetera. You need to have that diversification. And then to make it a little more complicated, but this is where the sophistication really comes in. Usually when we talk about risk in a more naive sense, we talk about backward-looking ex-post risk. So kind of looking at the standard deviation of returns, historically. If you really want to take it a step further, you got to be looking at ex-ante risk. So you got to actually project what risk will be going forward. That is something we're also working on. And in a lot of our strategies, that's really the goal is when we think about broader asset allocation or risk budgeting, it's ex-ante risk, not ex-post risk that we're looking to capture and then diversify according to our forward-looking view of risk, not just our forward-looking view of returns.
And you probably build in something that has sort of scenario analysis. If I boosted the outlook for risk in crypto, for example, to a certain base case versus another case, that may impact how you would actually rebalance or look at your portfolio.
Absolutely. And in fact, even in our client-facing version of Mosaic, we actually have, within our strategic asset allocation application, we have a way of changing our current forecast of risk and returns. So a client can actually go in, build an efficient portfolio, change their forward-looking risk, and see how that actually will impact the results.
And so an investor who puts assets with Franklin Templeton will have access to this. There's no additional fee or anything to it.
Exactly right.
Correct. Yes.
Excellent.
Yeah, we're not looking to be in the SaaS business. So long as a client, the person or the institution, I should say, is a client of Franklin, they're able to get access to Mosaic. So, like I said, if you're an institution watching, give us a call.
What about sort of the sophisticated retail investor? Is it there for them yet, or soon?
Not there for them yet. We're not looking, there's a rationale there because that's a question I've actually gotten from, not so much from retail investors. I don't usually talk to retail investors on a day-to-day basis, but from advisory channels, RIAs, we wanted to start with the institutions. And over time, we may release versions of Mosaic that are, more appropriate for, REAs, advisors, eventually retail. I do have a vision, like a really grandiose vision, maybe you could say, of like a way to bring all of the sophistication of an institutional asset manager down to the retail investor. And I think you need to do that in a very systematic way. I don't think you can just throw like, a manager research application that basically talks about different factor persistence and statistical significance of style versus size and things like that into a retail investor's lap without a lot of education. Or conversely, features that really simplify and make and put in appropriate guardrails. So that's something we're working on, and that's actually where I think a lot of our AI capabilities will come in. So for now, it's for institutional investors, but we're certainly working on making it available to our advisory channel as well over time.
It's certainly a big jump from institutional to retail. I think some of the best in the business, and Goldman comes to mind, tried that. It was actually a much heavier lift than they thought it would be, and looks like they're sort of moving out of the retail space. You said something just before in your answer that I wanted to ask you a bit more about it. You said digital assets. So when we say digital assets, I think many people think of Bitcoin or perhaps Bitcoin and some of the other major coins. But when you say digital assets, what should that encompass? Is it tokenized things as well? How big is this digital assets world?
You asked like my favorite question about this topic, so thank you. Because one of my biggest pet peeves is when a lot of times when I get asked about digital assets, they're really asking me about Bitcoin. And that is the largest digital asset by market cap, but usually when people ask me about stocks, they're not asking me about Nvidia, right? And it's kind of like very comparable because, well, what about, Lockheed Martin? What about SK Hynix? What about Eli Lilly, right? Like those are all different stocks. And usually when I talk about stocks, people want to know about sectors, they want to know about styles, they want to know about regions. Crypto is also not a monolith. Digital assets, and actually this is also why I generally try to avoid saying crypto, because crypto makes people think of cryptocurrencies. That is one part of that ecosystem. And actually, I would argue does not include Bitcoin. I would say Bitcoin is a network asset in the sense that its value is derived from us collectively assigning it value. That's where the parallels to gold come in. If tomorrow we all said gold is worthless, effectively be worthless. If we said diamonds are worthless, they would be worthless, and De Beers would have to do a whole lot more commercials to get us to change our minds.
We're getting there on that one.
Yeah. But then you've got tokens like ETH, which really underpins a technological ecosystem. Investing in an ETH is really like investing in the rails of the rail, that are going to carry the trains of progress for Web3. That's very different than the case for Bitcoin. When I look at things like Solana and Ripple, those are actually, I would say, the real cryptocurrencies. They're methods of transactions. They're competing with companies like MasterCard and Visa. When I think about, Uniswap, which is an automated market making platform, that is DeFi or decentralized finance. When I think about Mana, which is a gaming token, that's actually a way to derive revenue from video games, which for younger generations is not that different from working. And that's a whole separate topic we can get into a little bit later if you want. But the point is, there's all these different sub-asset classes within digital assets. And that's before we even get into things like RWAs or real world assets, which is where we're tokenizing things like collectibles or cultural assets like fine art, things like private equity and direct real estate, like actual physical businesses and buildings, and even brand new asset classes like royalty streams from artists. So the point is, blockchain has enabled this brand new way of operating and investing. And there's a whole lot of projects that can come online that support that ecosystem. And the cool thing is you can actually invest in most of them. And there's very little gating that exists in kind of the traditional investment community. But what I think is really important for investors, and this is actually where I'd say it's especially important for retail investors, is to not look at digital assets as just, the top three tokens by market cap.
Thank you for that, because I think most people will think, oh, it's Bitcoin, but there are many sort of other things that you can do. I do have a question, since you mentioned ETH and Solana. There have been arguments that ETH and Solana, the rails and the structure have cost so much to build, and that now that some revenue is coming in, that the revenue isn't what people expected it to be, and therefore ETH and Solana have suffered a fair bit over the past several months. And it will be sometime, it's sort of like tremendously overbuilt, and it will take a significant amount of time, probably measured in years, before those rails can really be used. Some people said it was sort of like fiber around the turn of the millennium. It took them a while to be able to use that. Is there truth to that in terms of is that overbuilt? It'll just take some time to get the traffic up to where people want it to be.
I think it's a fair point, and it kind of gets into an argument that I would say is we've seen within the hyperscaler. So I'll actually bring it back to stocks for a little bit, right? And we've talked about CapEx spending there, right? So, we've seen CapEx go, up to, I think over 700 billion a year in terms of where it's projected to be for 2026 from 150 billion in 2023, right? It's a pretty big jump. And for a while, investors were really happy about that overbuilding and building for the future. And now we're seeing some questions like, hey, what's the ROI on this AI story? Very similar with what's happened, I think, with some token projects like ETH and Sol, where there's a question of, did you overbuild a little too much? Were you expecting a lot more to come sooner? It's a fair question. I think for me, the answer is with both is you need to build for the future. And when you're valuing these tokens, similar to how I would look at valuing those hyperscalers, I need to have a proper DCF model that looks pretty far out for that terminal value. So when I discount it all the way back, I'm actually looking at that growth that's 10, 15, 20 years out, not at what they're going to do next year. So if you look at it through that lens, I think the overbuilding is, as you said, is more like right building and appropriate level of structural integrity. When you look at it in terms of, are we going to start generating revenue and really like justifying that build cost next year? Probably not. And that's where, you always need someone to take the other side of your view. So I think that creates a healthy market of the skeptics and those who believe in the vision. Personally, I actually think you need, in order to get adoption from non-crypto natives, you need to demonstrate that your rails are really sound. No one's getting on that railroad if the train is rickety, right? And that is what we need to see. So I actually think it was a really smart move to overbuild initially.
Sort of building for the future to, as you say, if the rails aren't good enough, then you turn people off and people won't come back for a long time. So now it's you've done a good, effective thing, and then the market can sort of grow into it.
Exactly.
I wanted a similar question. Looking through future portfolios, which is really kind of a wonderful site talking about past, present, and future. There's I forget who said it, but it was the view was that all your investments could be eventually accessible in one token. So my question there is, if I could tokenize my entire portfolio in several years' time, wherever it happens to be. Do I really want to do that? Because I think myself and other people might say, wow, all my stuff is on one token. that seems to be actually a little risky if I don't at least have an intermediary taking care of that token for me.
It's a good question. I think what we said, and I believe it was my colleague Sandy Call who said it, so I don't want to take credit for her great idea, is it would really be in one wallet, right? So your one digital wallet would actually contain the entirety of your investments. And those investments themselves, they're not managed by one company. Like this wouldn't even be, I mean, we'd love for it to all be Franklin, but I think investors will diversify with multiple sources. And even if you had an all Franklin investment portfolio, we would have different managers managing the underlying pieces. So these are still active funds that have teams or quantitative models behind them that are running this, as well as passive exposure that might be pure asset plays. But I want to hit on another part you said, which is the risks. I think the traditional risk we've seen with wallets is the fact that if someone has your private key, they have your wallet, right? That is the part that can actually be solved quite efficiently because we can create a traditional KYC environment and traditional security for any crypto wallet. So like there's, like not your keys, not your crypto is been the mantra. And like, for my personal MetaMask wallet, for example, like, yeah, if someone got my private key, that would be very bad. For a more, investor-focused approach, we can actually tie identity to the wallet if an investor wants that. For any institution, well, obviously we're going to still be required to do all our KYC. So that's not even going to be an option. And so there are ways to address that security, and there's also a way to actually protect that key even further, with multiple cold storage options, with physically splitting the key. So there's been a lot of work done on that space. And the reason I wanted to bring it up is a bit of a tangent, but I think it's a critical part of what you said, which is what are the risks? And a lot of those risks that traditionally have existed in digital asset space have been getting addressed more recently.
I think it's important for people to feel comfortable with that because even I think some sophisticated investors are still a little concerned about private wallets losing your key. I read the disclaimer on the site. It's a great disclaimer, and it literally lists all the risks that you could have with sort of a wallet and a tokenized asset. So I appreciate that. I thought that was quite useful compared to some of the you see advertisements for drugs, and they list all sorts of things like if you're allergic to it, don't take it. Well, okay, I could have figured that out. But it was really well done. I want to pivot a little bit and get your views on what's happening in the markets. And there's a heck of a lot happening in the markets. So let's start with the 8,000-pound gorilla in the room, sort of the geopolitical situation with Iran and its impact on financial markets. And it almost seems as if it's, are any ships getting through? What's happening with the oil price? And that's driving everything else. So is it, a lot of people are concerned about that, but some people are thinking it's about noise. So if you're telling investors today, with a conflict like this, where it's, what it's doing is overriding fundamental and technical factors, how should people think about it?
So I think the conflict is real. I guess there's gravity to it, is what I mean by that. I think the prudent thing right now is to recognize where you have conviction and where you don't. We've spent the last 2 weeks talking to all the geopolitical experts we know and trust. Folks who've got experience on the ground in military operations, folks who have contacts in Tehran, in Tel Aviv, and in Washington, as well as some of the other regional neighbors. And the consistent narrative that I have heard is this is going to be an extended conflict. One of the reasons is ultimately Iran has to make the decision to come to the negotiating table. It's a lot easier to play defense than offense in a war. And especially when you are playing defense by causing chaos. Think about the fact that if you're trying to get an LNG tanker from the Strait of Hormuz, you're basically trying to get a giant bomb for a war zone. I mean, that is not an exaggeration. You can't have a Navy escort of an LNG tanker because one tiny drone will blow up the whole thing. And this isn't Top Gun. Like you're not going to have a jet fighter take out 100 drones in a swarm. If you're taking an oil tanker through, it's not quite as big of a bomb, but it is still highly flammable. So no ships are going through the strait. In terms of mines, Iran has really advanced mine laying capabilities. I think a lot of folks, when they hear about mines, they kind of hear about or they think about, like the World War II ball with the little spikes on the end. That's actually not what mines are. They've gotten much more advanced. They can detect specific ship signatures. They can be moved remotely. They are placed in a much more advanced way. Iran, from our sources, has several thousand what are called midget submarines, which is not a term that, to be fair, I've heard before this. I don't want to sound like I'm the geopolitical experts, but the people who are have explained them to me. And basically, unless we cluster bomb the precise location of where they're stored underground, which obviously we don't know, we're not getting rid of them anytime soon. And so even though there is a more concentrated air campaign at bombing known sites, bombing the ships, bombing missile silos, yes, we can take out all of that infrastructure, but Iran's ability to keep the strait closed and wreak havoc is not ending until Iran decides for it to end. And that is why, in our view, right now is the time to be very careful with how you're positioned in terms of risk.
I like what you said about this is a time for sort of high conviction. Would it be accurate to say that hang on to the things that you have the highest conviction in, and if it's something that you're not so sure about, you've been thinking about, is it a good time to sort of have a larger allocation of cash with the whole idea with cash drag and things like that? Is that a good way to approach it?
So we're looking at it a little differently. We are broadly neutral across our main asset class buckets. So again, kind of depends across the type of strategies we manage, but generally speaking, if our benchmark for a strategy is 60% equity, 40% fixed income, we'll keep the portfolio right around that 60-40 mark. And so we're not overweighting cash. We are instead looking at duration where we think there's benefits to duration. So actually away from the US and more towards European bonds like Boons, UK gilts. That's where we're seeing more of a benefit from being overweight duration. We are generally long dollar. We think the dollar is going to get bid as a safe haven, but not necessarily treasuries. We think treasury yields can actually go up, largely because the Fed playbook really does change with what's happening. And then, beyond that, we actually have high conviction in certain equity asset classes, like, for example, South Korea, Taiwan, and Japanese equities. We remain highly convicted in, even though their economies are going to be impacted quite severely by the Gulf oil shortage. Their actual businesses are primarily export driven. So like I'll use Korea as an example. About 60% of Kospi stocks revenues come from outside of Korea. A lot of the automakers like Hyundai and Kia actually produce electric cars much more so at a much higher rate than European or US automakers. So they actually on margin benefit from higher gas prices. When I think of companies like I think I already mentioned earlier in the pod, SK Hynix, also Samsung, missiles need memory too. Data centers are going to continue to get built. So companies like TSMC as well stand to benefit. So the electronics super cycle, the AI super cycle is not ending. And so I really want to lever to those names. I have a high conviction that those companies in those markets will do well. Within Japan, we've got new leadership, over $20 trillion stimulus, yen stimulus that's been announced. And I have a lot more faith in that than, say, reforms in Europe that have not done enough, where there were macro issues before the war, even though from an oil perspective, Europe is much more diversified than emerging and developed Asian countries are. So that's what I mean when I say high conviction. It's really sticking with the views where you see that long-term vision, and where you don't see a long-term vision, that's where you want to pare that back to neutral.
That makes a lot of sense. In terms of the and without giving away anything that may be confidential, but the experts that you mentioned that you've talked to, that the Franklin has talked to, across the different disciplines, any sense of, it's going to last for a while? Any sense? Are we talking about 3 months, 6 months, perhaps even longer? Any sort of consensus, I guess, is what I'm asking.
Not really a consensus. We know that the what's called the Air Tasking Order, or ATO, which is basically the U.S. military directive that's been issued, isn't even over for another 3 weeks or so from today. So I think that, that's kind of the next even potential catalyst. But beyond that, there's a view that, likely not more than 6 months, potentially 3, anything less than 3, you start getting into much lower likelihood. There's a lot of dissent across the different people we've talked to. And that when the experts can't agree, me as the taker of that expert opinion, I would rather not have an opinion then, right? So I think it's too early to tell, but I would say based on where the consensus, pin is in terms of timeline, I would look at several months out. I would look past May for the conflict ending.
That's good to know. Have some sort of, I wouldn't say perhaps not anchor, but some idea of where it likely is to be. And it sounds like 3 to 6 months may be a reasonable area, unless something changes, which particularly with this president and oil prices and other things could be overnight. One of the reasons why the crypto market is useful, you can check on Saturday, and if it's moved a lot, you figured something probably happened. Speaking of crypto, one of the, I guess, an asset class has done actually surprisingly well. Almost decoupling from equities, to which it seems to have been attached for the past few months, and made that low before the war. Now it's coming up, and Bitcoin's holding 70,000. Everything's looking sort of good. Is there a subtle change in the tone of the crypto or crypto markets?
There has been, and I think a lot of folks have said this is crypto's moment and have been completely wrong, so I'm definitely not saying that. What I will say is there are certain groups, especially in the Middle East, where for them the crypto on-ramp may be really accessible and the best way to protect their wealth, which, usually you wouldn't hear crypto and protection in the same sentence unless how do I protect from crypto volatility? But I think we're seeing a bit of that, of folks moving on chain, moving specifically into digital assets, not necessarily just putting them onto stable coins. So I think that's happening to some extent. I also think there is an element of what we would call the debasement trade from last year that's resurgent, where yes, the dollar is getting bid. Again, we're along the dollar right now, as within my group, but there are investors who believe that there is a long-term structural issue with the dollar, because there's a long-term structural issue with American exceptionalism. And then again, it may make sense to go not to another government, but to something that's decentralized. And I think that is the marginal bid that's happening. The other part, and I think this is the less, I guess, geopolitically sensitive part, but it's probably more important, is we had a huge deleveraging moment in digital assets last year, right? Like the October 10th crypto deleveraging was extremely pronounced, and that was largely driven because there was so much leverage in the system. You had digital asset treasuries or DATs that were trading at multiples above their holdings. You had hedge funds that in some cases were levered, I believe, like more than 50x in their positions, which just to me, it's even hard to say that because crypto is so volatile. Why would you lever it? Like this, we're not talking about, a bond strategy where that may make sense, or even like long short equity. This is the most volatile asset class in almost any portfolio. But when that happens, you have margin calls. And the way crypto exchanges like Hyperliquid make margin calls is very similar to how platform shops like Millennium and Balyasny make margin calls, which is they just cut your positions. It's indiscriminate, and it is a executioner's axe on your risk budget. And so when that happens, it spawns more liquidations, it spawns more margin calls, it sends prices into free fall. And that's exactly what happened. So after all of that came out, we actually hit closer to a technical bottom where there were no more margin calls. And so from there, there's a bias to go up rather than go down. So I think that's the other component of this and why we've seen crypto prices actually pick up year to date.
It really has felt differently where you'd expect it to be down, but it's actually holding and holding pretty well, maybe down a little bit in a heavily down equity market, but certainly looking up. Would you say that, and when you say 50 to 1, it brings me back to, and I'm aging myself now, to the long-term capital days back in the late 90s. And I think the market learned a really good lesson from that. Do you think the crypto market or the exchanges have learned similar lessons that we won't have, we may have 5 to 1 or 10 to 1. We're not going to get to 50 to 1 anymore?
So well, the thing I've often said about the crypto market is it learns the same lessons we all learned as TradFi investors. It just learns them much more violently and much faster, right? I mean, I think back to the Luna algorithmic stablecoin scenario, and I'm like, man, like at the time I was thinking this really reminds me of subprime loans and like all that collateral on top of nothing and like the multiple layers of junk wrapped with treasury bill on top and rated as AAA. Like all that stuff. I mean, it was rhyming so much. But a lot of the people I was talking to at the time, and at the time I actually had a digital asset hedge fund, they were crypto natives, as in they thought, here's this TradFi guy telling us some junk. We're going to go long into these algorithmics. Okay, well, history doesn't quite repeat word for word, but it rhymes. And so I think exchanges certainly have learned some valuable lessons the hard way here. I don't think you're going to see risk being doled out quite as freely. There's probably still going to be some fund that figures out a way to do it. Again, we see this in TradFi as well, right? There's always some hedge fund that somehow figures out a way to skirt counterparty limits and levers up too much and blows up, and there's a market dislocation. We've just learned how to manage that because the institutions have learned how to manage their aggregate liquidity and aggregate risk better. And I think that is happening in crypto. And that's what's going to make institutional investors more comfortable getting in. We actually need that volatility to dampen for the market to start being more palatable to institutions. The interesting thing is it's going to be a bit of a snowball effect, I think, is as more institutions come in, as more institutions hold more in the space, you're going to see the volatility further dampen. And look, that may result in not seeing those eye-popping returns that we've seen in the market, but that's actually a really good thing. That means the market is getting legitimized. And, not to date myself, but we saw the same thing with high yield debt. We saw the same thing with emerging market loans, actually with leverage loans, and even with things that are very basic, like international small cap equities. I mean, that used to be a wild idea that anyone would want to hold, small companies outside of the Russell too. Now it's in the most boring retirement portfolio, right? So I think that's just part of that normalization process. And again, it's just happening a lot faster in crypto.
For folks who were in crypto and and are out and want to get back in, and or folks who have not done it and think maybe this is the time it's been washed out. Let's just take Bitcoin, I suppose, as an example. Though I think you said accurately that maybe you shouldn't consider them alongside all the coins, but if someone were to say, I want to invest in Bitcoin, what's the best avenue to do that? Is it the coin itself? Is it the futures, the ETFs? Is there still room for folks like MicroStrategy, which once upon a time not so long ago was actually a very liquid way to get into Bitcoin? What do you think is the good ways to get exposure?
I think there's a number of good ways, and it really depends on each investor. So I'll walk through some of the examples you mentioned. I mean, I would say the simplest way to get access to a single token is just on chain. It's not very difficult to create a wallet and add crypto to that wallet. Now, for some folks, they want the convenience of having their exposure be commingled with the rest of their public market, stocks, bonds, munis, etc. And ETP products are, which are basically for most folks, they'll think of them as ETFs, but technically crypto exchange traded funds are ETPs. They'll go into that avenue. Again, there's a fee to that, but the fee relative to the volatility is so small that it's not doesn't really matter that much, right? And you're getting, again, without any of the hassle or complexity, if you will, of going directly into the token, you're still getting all the benefits, especially now that we can actually derive staking yield from exchange traded products, which was a big development last year. And then you've got the DATs and other alternative ways and perps and futures and all that. That is where I would say, if you are a retail investor, really think through why you want to go that route. Then there are much cleaner routes to get what you want. As a general rule with investing, if I want, for example, to be long crude, I'm going to buy crude. Like I'll buy the futures. If I can't buy the futures because my account isn't big enough or not enabled for futures, I will buy an oil fund that holds crude futures. And I'm rarely going to try and go and buy like oil services because yeah, they are going to have a beta to that, but that's not really what I'm getting. There's additional risk that I'm taking on. So the same thing, again, as we talked about before, the rules of the road are not that different with digital assets versus traditional assets. Get the exposure you want, not an exposure that gives you something else. You actually don't want the something else. It's not necessarily the gift that you may think it is. And so that's why I would really encourage, especially retail investors, to stick to specific exposure that gives them the tokens in whatever way makes sense to them, whether that's on-chain directly or whether that's through an exchange traded product or fund.
Now, what about sort of like the micro strategies or similar similar vehicles where they used to trade at a tremendous premium? That's all come out. Any chance of them coming back?
That's exactly the risk, is they were trading at a premium to NAV, but why? Like, by the way, that's another simple question. Like, people often ask me for like just general like rules for smart investing, and I would say, if something's trading at a premium or seems expensive, like ask if that expense is justified. There was no reason for MicroStrategy to trade at a premium relative to their holdings of Bitcoin. Like, they're not doing anything with those holdings. It's not like they're running something that will generate additional value. It's a treasury company. At least that's what it effectively became. And all those DATs that were trading at a premium, it was just a matter of time till that premium got completely eroded because there was no justification for it to exist. They weren't giving anyone an additional benefit. So why would they trade above their NAV?
It's a very, very good point. Now, I want to move to an area where I think you have specific expertise, and the market is still focused on it, but a little less so since the whole Iran thing. But AI-driven job displacement and the impact that it could have on the economy. The SaaS people, I guess, felt it the most, and that's been trying to bounce a little bit. With your background in AI and AI investing, the doom and gloom stories that we have seen, some of them seem actually quite credible, even though if their timetable may be a little bit shorter. What's your view on how, is AI really coming for human judgment in some of these white collar jobs that, have previously been immune to technology?
So I think AI is going to come for some jobs, but what does coming for those jobs mean? Well, it's really more about changing the way those jobs are going to work and what the roles actually are versus eliminating them outright. So I think there's probably going to be, in our projections are something like 90 million jobs displaced by AI, 170 million jobs created. So net, that's actually about 80 million of new jobs. But the important thing is that almost every single job, if you're a white collar knowledge worker, your job's going to be impacted by AI in a pretty significant way. You're going to need to change the way you operate. And then for some cohorts, you're going to see your jobs completely go away. especially, I would say for any work that's more clerical, if you will, that's more pure research driven, like find X, summarize it and put it into a specific type of form. Like that work can be done by AI right now at an extremely fast, low cost way. More creative work is more open, but it will be, and already again is being impacted. And then there's going to be brand new jobs that are created as well. What I think is really important and what we've seen from a market perspective is this, wide selling of software. Like I said, all the SaaS companies taking a huge hit. We've seen it reverberate in private credit in particular, where there's certainly, more concentration of private credit loans that are software based. But here's just a simple question to ask. Is it better for Anthropic, as an example, to work with a company like Workday and Salesforce and sell their products to them where they have a deeply established client base? Or is it easier and better for them to take those companies' clients away by creating something brand new that resembles Workday or Salesforce? And I would say the answer to that is it's much better to sell your products to those companies and not have to build out, a CRM or an HR platform, right? So I think that's much more what we're going to see is those hyperscalers, those AI foundational model builders working with the SaaS field. And actually, this is perhaps the irony, and this, in my view, is an opportunity within that space right now. It means their margins are going to go up. The margins of the SaaS companies should go up because they're going to be working with the AI companies to further streamline what their products can do, which means they can run more efficiently with less human capital. And they also, at the same time, introduce additional features which make them even have more of a foothold with their enterprise clients than they do right now. So I think that was something that was fundamentally misunderstood about that situation. Just because, and by the way, I use Claude Code quite extensively. I use GitHub Copilot, I use Codex, right? We talked about building Mosaic. I'm not writing production level code, but I'm certainly toying around with it. And my team is absolutely using all those tools for production, as well as my quantitative researchers. It is tremendously accretive to our productivity. It's tremendously accretive to our ability to generate alpha. We've got products that I'm happy to talk about. Internally, we've been building that are agentic and helping us do even fundamental research, including on every single thing I've talked about. But it's augmenting our labor. It's changing the way we work. It's not replacing us.
I think one of the things that has, I think doom sells, right? People loves to click on doom stories. And Matt Schumer, that initial post that you could argue kicked this post off, I think he's probably got 90 million views or something like that. But something you just mentioned, and if you could write something similar to that, maybe you'll get 90 million views. When you say that it's going to cost maybe 90 million jobs, one might bring in 170 million jobs. I guess the people who are in those 90 million jobs are can see that AI might be coming for them, might take their job, or that many fewer of those people. You can see what jobs are at risk, but it's harder to see what jobs are going to be created. Any ideas of, and you said that the the Anthropics of the world are going to end up working with these SaaS people to build out, but where are some of these new jobs likely to come from?
So I think you're going to see a lot more work that actually requires people to be people. AI is not great at emotional intelligence, and those kind of things are really important. So I'll give you an example for us. We can have AI build a financial model like a DCF model. In a few years, it'll probably build a more sophisticated, robust model than a human. We can also have AI talk to a human, right? But is it going to be able to pick up the nuance when I'm talking to a company CFO in a live conversation in person? Is it going to be able to walk the floor of, let's say, a data center and really be like, some of these cables aren't really plugged in the way they should be or routed correctly. I'm going to ask some follow-up questions on that. Those little minute details, humans are actually excellent at picking that up. And so I think you're going to see more work like that. That's actually much more focused on intelligence in the real world. Because despite what, Elon might say, I don't think we're going to have humanoid robots running around everywhere anytime soon. And potentially in that capacity for the foreseeable future. Then you're also going to have humans that are being more creative, and that's a big word, right? Like being creative. And I'll as an example, sometimes we'll speak at colleges, and I've gone from telling students you need to have a background in Python and be able and data science to saying you actually need a liberal arts background and learn philosophy, learn how to think. So when I say creative, I'm thinking like capital T think. How do we come up with new approaches, new algorithms? We can have AI backtest and stress test a lot of ideas very fast, but truly original thought, that's still much more difficult. And I see that. Like I love collecting art, and I can create pretty amazing drawings using models like Nano Banana. I've actually I bought more human art, and to be fair, I haven't bought any non-human art, but I've bought more human drawn art in the last couple of years just because I actually want that real connectivity. I want to see the brushstrokes. I want to know about a human laid it down. I can create really great songs with Suno. And one of the things I've been doing for a lot of my friends is like sending them like what sounds like an absolutely hit song. By the way, in any language as well, right? Like I can do that. I can have AI write the lyrics, or I can write them myself. It'll sound like a top 10 song. It won't sound like the song that actually gets people thinking and gets people excited. So again, like, do I actually listen to those songs myself? No, I listen to human, made tracks, and I've been spending a lot more time with like deep cuts of my favorite artists because I want that human connection. So think about that concept as well. The more that we get in depth with AI, the more we need to also be around other humans. The more AI can do work that's really time consuming and iterative, even if that work does require some degree of lowercase t thinking, lowercase c creativity, the more we need to do the uppercase t thinking and uppercase c creativity.
I like that idea. In some ways, it could be, a very disinflationary thing because the productivity is going to go, so much higher. But and you could certainly see that coming. And then people, learn to do other things. That's harder to see. And you probably should write something, as a counter to Matt's humor and see how many millions of views you can get on that. Because I think that's that's a very, very, very good point. I do want to move along to some of the some of the markets that folks are investing in. You mentioned private credit a little bit earlier, and private credit is its head is starting to come up. Jamie Dimon famously says there's just not one cockroach. Do you see a deep issue with private credit, or is it maybe a situation where you need to just maybe choose the right managers that you want to be with the double and triple A managers and not maybe the single B managers when you're coming into something like private credit? What do you see that asset?
I think you absolutely hit it. Manager selection is extremely important in privates in general. We've done a lot of analysis across our manager research team and our privates teams within solutions, because again, we actually have full manager research group. And what we found is there's much more variability in the manager in terms of returns between managers you pick within a single private asset class than sometimes there is in different asset classes altogether. So like picking the right manager or the wrong manager, say private equity large cap is going to have more variability than picking between the median private equity manager and the median Series A venture fund. That's how pronounced those manager differences can be. So that's really important. And within private credit, look, I think it's fair to say that there are risks. It hasn't really been stress tested for something like the GFC, but a lot of new asset classes haven't been stress tested like that. So you have to be comfortable taking on that risk. I think that the important thing is to think about how does the actual underlying manager diversify? Are they really pegged to a single asset class? Are they looking strictly at Cov Light, or are they looking at more covenant-rich issues if they're primarily, structuring their loans in the primary market? Are they getting more favorable terms? If they're playing in secondaries, what's their approach to that to make sure they're actually getting things that people aren't just dumping on them? Those are all big questions that investors need to figure out when they're investing in private credit. I think making a blanket statement about an entire asset class is almost always going to be more of a headline grabber than actual investment research. And so I would say Jamie isn't wrong. There's going to be more cockroaches that creep from under the floorboards. But it doesn't mean that if you own private credit, you are any more liable to see that cockroach than to say that because my neighbor has, a problem with them, I also will have it. Maybe I've just got a much better exterminator and I'm better at keeping my house clean. So that's the key difference.
I like that. Keep your house clean. You don't have to worry about the cockroaches. Choose your managers carefully. You mentioned, I just want a quick follow-up. You mentioned earlier that there are some cases like in Korea and Taiwan where they may superficially have exposure to energy, but they actually derive, I think it was Korea that derives 60% of their revenue from outside of the, not domestically, that they're actually a good choice, perhaps better than Europe. Are there specific areas of emerging markets or, ex-US markets that you particularly, in addition to those, that you particularly like versus ones that you're a little more careful about?
Yeah, absolutely. So we're more careful with China right now. China had structural issues before the conflict broke out, and ironically, China is to some extent less at risk specifically from the oil markets, even though they derive so much from the Gulf. They also have stronger reserves. They have additional energy sources relative to, say, South Korea, Taiwan, some of the other smaller Asian emerging economies, but they still have a real estate issue. They still need to do a lot of deleveraging. There hasn't been appetite to really stimulate the market. And so, there we see less opportunities. I think in some of the more consumer-focused economies, there's the tariff risk that remains an overhang. There is more potential that inflation is going to be more difficult because if you're in the business of, say, making clothes or other consumer goods, that's a people business. If those people need more money because they need to get to the factory and gas is, 3 times what it was before, you're going to need to, just to keep your margins what they are, raise prices. And that's going to, just Econ 101, reduce the demand function, right? And then on the flip side, you've got, the regions that I mentioned, like South Korea, Taiwan, where you're primarily producing very inelastic and fairly expensive goods like semiconductors. And, I call it the chips and shovels trade, where if you think that there is a secular bull case for artificial intelligence and for data, and I think anyone who's gotten this far in the podcast knows my view on that, then it makes sense to invest in those chips and shovels. There's really not a lot of substitutes for them. No one has the kind of fab facilities that TSMC does right now. It's hard to not put Samsung memory chips into your electronics devices, whether they're an iPhone or an enterprise-grade data center or server room, right? So that's where I see those opportunities. And yeah, those economies are going to be hit. The more oil stays elevated, the more that's going to be difficult for those markets. But when so much of the revenue comes from these inelastic exports, I believe their equity markets are going to be relatively less hurt. And again, I say relatively, I'm not saying they're going to go up, but I think they're going to be relatively less hurt. And moreover, there's a more of a J-curve opportunity. So if they keep going down because of the economy, I would, again, I'll say what a lot of good investors say. This is my view right now. It may change depending on what else happens. But as of right now, if they take another leg down, I would be a marginal buyer.
Great. And the last question I do want to ask, and it's going to actually probably have an effect on how the war is waged, at least from President Trump's point of view, is the midterm elections are coming up in the United States. Plenty of talk about it. There'll be more talk as we move forward in time. Any specific way that you're looking to play a year of the midterm election?
It's a good question. Always think about it in these years. What I've learned through being for quite a few election cycles is you fade the headline risk until you get to the point where the primaries are really in full swing. And that's when things really start mattering. So look, of course, Trump is concerned about midterms. Of course, he's aware that he's going to need to wrap up this conflict by the time people start heading to the polls en masse. But that's really not going to hit until later in the summer. So earlier I said, I think this conflict can last until May. From a midterm perspective, it can last longer before it really starts hitting, because if the conflict ends right as people start heading to the polls and all of a sudden you go from $5 gas to $2 gas, that actually could play well. I think there are other issues that are going to be coming up, and I think a lot of them right now within the US are much more domestically focused. So of course, immigration is a huge issue, and it's been one where Republicans have not handled it very well with the general population. I think within the Republican Party, there's obviously fractures because of the war. A lot of people elected President Trump on a non-interventionist policy, and he's done kind of the opposite of that. Especially if you think about Venezuela even before Iran, and Operation Midnight Hammer before Operation Epic Fury. So there's those fractures within the broader MAGA movement, even not just the GOP. And of course, there's the interesting thing that even though the economy has actually done fairly well, at least up till now, the perception of the economy by the average consumer has been that it's getting worse. This is where I want to dig in one layer deeper, because what's actually driving that is the higher end consumer has continued to consume. They're doing just fine. They're much more pegged to the stock market, which of course saw pretty strong returns last year. But the lower end consumer, they're starting to really struggle. And the A word, affordability, is ultimately going to be the biggest thorn in the dominant party side, which in this case is the GOP and the MAGA Republicans. Because those lower end consumers, they're starting to see higher credit card defaults. They're starting to see mortgage delinquencies at a rising rate and missed payments on mortgages. And they're the ones who can't afford gas to get to, one of their potentially multiple jobs. That's where I think there's going to be a lot more of a theater within the war between the left and the right. And how do we play that? Ultimately, no policy is going to get decided in the midterm. So again, we're going to see those headlines, but from a market impact perspective, until we start seeing who's actually winning, which we're not going to know until November, we can't even really start drafting potential market implications. And so again, my view on elections is for things that are hinged on the election itself, like the conflict with Iran, yeah, that's going to need to have a catalyst before the elections. For things like, what are we going to do about the lower end consumer? What's going to happen with tariffs? Et cetera. That we need to see who actually won before we start making investment views, or at least we need to have a pretty good expectation of who's going to win.
Great. Well, Max, thank you so much for spending so much time and touching on all these different topics that a lot of our viewers are very, very interested in. And we look forward to having you back on the show again soon.
Thanks so much, Ty. It's been a great world tour of all these different areas.